through my strategy basically. Yeah, I mean, it's obviously I can't go into all of the nuances of it. It would take too long. That's why we've got big, courses that are set up to actually do this. But yeah, I'll run through that, see how it's applied in the market, see what we can learn from it, and take it from there. Really, that you have sent through quite a few questions for me to have a look at and answer, which I will be happy to do so. And if you do have any questions as we're ongoing, then by all means submit them, but do them in the Q&A section, please. That would be quite good if you can. I won't be able to answer all of them, from past experience. So I apologize now if I don't get to them or miss them completely or whatever. It's not by design. It's just purely just time limits, or if I'm just focusing on one thing while I'm telling you, then I might miss what you're asking. But I'll do my best. I'll try and give you as much information as I can, and hopefully you can find some added value from this. So what I'll do, I'll share my screen and we'll get cracking. Okie dokie. So here we go. Darwin. Nathan's from Darwin. Hey there. That's good to see you. Interesting. Wonder what time that is. That'd be quite late, I assume. Anyway, right, let's have a little look. Who am I? If some of you don't know who I am, I can understand that. That's me and the family. So my wife Claire, and then the boys Theo and Xander from a couple of years ago. So they've grown up a little bit since then. Little Xander there, he's actually stood on a step, so he's not quite as tall as that. But no, the reason why I got into trading was because we actually wanted to have a family. And the job I did before was one where I couldn't actually do that because I was away. I left early in the morning, came back really late at night, or even early hours of the morning again. Hardly saw my wife, let alone have a chance of actually having a family and doing justice to that family, because I wouldn't want to do it. Have a family if I was just leaving it all down to Claire. It wouldn't be fair. And so something had to change. So I did change tack, and I found this thing called trading, which fascinated me. And I went part-time pretty quickly at work to try and just get a good grip of what I was doing within the trading world. And I thought, yep, I'm ready to go. So this was after about 6 months, I decided I'm going to go full-time, pack up my job completely. And this was in 2007. So I've been full-time since 2007. Little did I know how tricky it was going to be, and also the pressures of trying to make money to replace the income that I'd actually lost from stopping my job. I hadn't actually started to be really that profitable within those 6 months at all. And so I went into it assuming that the float that I had behind us as a family could keep us going long enough for me to be profitable, but it was really tough. And there were some really scary moments in there, but I'm probably a bit too stubborn to give in, and I kept on going, and luckily it changed everything for us, and it gave us the quality of life. And I'm not talking about just money situation, it's the quality of life that has changed, well, just turned upside down, completely 100% better than it was. Well, more than that. It's just totally changed our life. I'm there for the children every time they go to school. I'm there for them when they come back home. We can spend proper time together as a family and do things together, and it is invaluable. And that's what trading has given me. That's the number one thing. Obviously, the money side of it is really good, and that's not to be dismissed, but it's the time that we can spend with the family. But anyway, enough of that. So I've been going since 2007. Seems like, I mean, that is ridiculous in itself. That's 18 years. Madness. So what do I do? So as Jonathan says, I look for reversals in the market. So I'm not one that necessarily bothers about trend and following the trend. I'm looking for areas and levels in the market that are likely to produce a reversal, and I'm looking for certain patterns of price action that tell me that reversal is going to be ongoing very shortly. And there's two different methods I use for that, and I'll talk mainly about one today because we can't talk about both. One, the slightly more simple one, if you want to call it that, although it is deceptively simple, a lot of nuances to it. And that's basically a double top situation. So that's where Price has tested. In fact, there's one showing here on the chart. Testing an area like this, reversed off it, and then testing it again. And this is producing what is something like, I call them an M top because they look like the letter M. If that now reverses down this way, then you've got something that looks like a letter M. So let me just walk you through this from the book. What shows in here? Many of you will have got this book, so you'll know it, but some of you, well, probably many of you won't as well. This gives an overview of what we do within the cafe and academy as the instructors. Just one of our strategies. Most of us have got 2 different strategies. Sid's got one, but the rest of us have got more than one. But it's but still, this one obviously describes one of those strategies. And so let's have a look. See, it gives a little overview of me, and it'll do the same for the other instructors. But this is me. I'm based in the UK. Talks about that. A little bit of my history goes into how to evaluate yourself for psychologically, and also what your availability is to trade. Whether whether you can actually commit the time to do this, and what time frame might suit you. And then it talks about my strategy itself, which is here. So how do we do it? Well, it's looking very much like we're looking for an impulsive move, moving up, then a pull back, and then a push back to a similar sort of level. As this doesn't have to be exactly the same as each other, but they have to be within parameters, which again, we have a way of measuring that. And then if we get then this downward movement here that breaks through the neckline, which is the low point, the low bodies between the left side of the M and the right side, if we're going to break through there, then this move here is what we can benefit from. And that is likely to happen. If we've read the pattern correctly and read the previous price action correctly and checked for the fact for news and all sorts of different things that we do, so we've done our due diligence on the trade, then this is very likely to happen. Around about 72% of the time that will happen. And the same for a W bottom. So again, an impulsive move down, a big push down, a pull back, and then a push down to a similar level, break of the neckline here. And this is the bit that we benefit from in this bit here. So then it goes on to describe it a little bit more about shows in real size and time. Don't know if we can get that any bigger, but anyway, it's apologies, it's quite small. Let's go. There we go. We'll get a bit bigger. One more. And so this is what we're looking for, an impulsive move up. So this run here, so if we can look at this, all green candles with one exception, which is a red one here, which actually is important. We'd need to be checking that one out. But anyway, we've got this impulsive move up, a pull back and a push back to a similar level, break of the neckline, which is on the lowest bodies between the 2 sides, and price sells off. And the opposite is here. We've got an impulsive move down, pull back up, push down to a similar level, break of the neckline here, and up we go. Relatively straightforward, but as I say, deceptively so. And then we can have a look at, sorry, it's going to be scrolling through. This will walk you through it in stages. So what we're looking at and what it looks like as it's actually building. So this is the same price. So this is the impulsive move up. Doesn't look much like an M top at this stage, but this is the key to being able to recognize it quite early and start doing your due diligence and looking for things early on. And yeah, Nathan says, how volatile is Forex? Quite volatile, but you need volatility to be able to profit from it. So varying times, different times of the day will be more volatile than others, like the open of the London session, the open of the US, the New York session. Any big news events will make it quite volatile. Like today, we've had quite a reasonable amount of news today, and economic data coming out of the United States, which affects quite a lot of things, increases the volatility. You've got to navigate your way around that. So very, very clear. You're going to need to have a very clear view on what's happening in the day to be able to benefit from this. Yeah, and so we get this pullback here, we can do a lot of work before before we get close to triggering a trade. We can do a lot of the due diligence beforehand, so that then if the market does present what we want it to do, or what I want it to do, I can take advantage of it. That's all I do all day long is wait for the market to present exactly what I want to see, and then when it does, I'll take advantage of that. I don't try and shoehorn things into positions and say, oh, well, that's near enough or whatever. Just let the market come to you and then take advantage of it. If you know you've got an edge in the market, then you can just wait happily for the market to present that edge to you and just repeat and repeat and repeat. Of course, it's not going to win every time. Never does. Nothing does. I don't control the markets, and nor do you. Sometimes price action will behave randomly. Well, say randomly, not exactly as you expect it to do. Let's put it that way. And the institutions fight between themselves. It's not them against us by any stretch of the imagination. We're nowhere near big enough to supply all the liquidity for the institutions. So it's not them winning all the time and us losing as retail traders, as it's often portrayed to be. Of course it isn't. They have to take liquidity from each other. So they're actually trying to trick each other into doing different things. And as long as we understand that to some extent and have this edge in the market, then we can benefit from it and jump on the back of things. So yeah, this just walks you through all sorts of different scenarios, makes it fairly straightforward. And then as we get, I'll make it a little bit smaller again so I can get down. When you can set pending orders, so you don't have to be in front of the screen, to benefit from these setups. When price goes sideways for too long, what do you do sort of to exit the trade? When do you manually close it? Where's your stop loss? Where's your take profit? What are we looking to get out of this? It all walks you through. Quite a lot of the detail here is in this book, so it gives you a good overview about what I do for one of my strategies, which is the M's and W's. So hopefully you find that of value. If you do, if you do get that and have a look, then it'll give you an overview of what we all do. And then if you like that, then you obviously can take it to the next level if you want to do that. So all good. So what does this look like in the markets? Let's have a little look to see what it looks like in reality. Cameron asks, what time do I usually trade? I start work, or my analysis starts at 5:45 every morning, UK time. I'm a fairly early riser. I like to get my analysis done fairly early, and that sets me up well for the trading day. So that normally takes me an hour and a quarter or so. It allows me then a little bit of time to just see the kids in the morning before they go to school, and then I can come back and be in full trading mode with most of my analysis complete. I will then redo that analysis at least once more through the day. Normally that's before the US Open, which is 2:30 in the afternoon for me. It sounds like you should be going to the dentist, isn't it? 2:30, but yeah. So do that again, and just periodically just double check the smaller time frames. If I'm trading the smaller time frames, I do more analysis throughout that day, but most of it's done in that first thing in the morning, and I'll stop trading. I won't take any more trades after 6 o'clock in the evening, and everything gets shut down pretty much at 9:30 at night. Now it sounds like that's a long day. It is a long day, but I don't have to be in front of the screen all the time by any stretch of the imagination, so it's not a problem. So let's have a look at this in action. So I think I'll actually have a look. I've shown you this one here as it's developing now. So we've got this impulsive move going up. So this is live as we're looking at it now. We've had a pullback and we've got to push back up to the same sort of level as here. So as price comes down here and will break through the neckline here, assuming it does, then we can benefit from this move here. And I don't get greedy with this. I like to mostly just take 1-to-1 risk to reward. So as it breaks the neckline, the price, I will put my stop loss behind the pattern. I don't need to worry about rogue wicks like this one. If it does close here, then I can have the stop loss above the pattern, and then take profit will be down here. I won't look to normally extend it too far. Occasionally I do, if there's a very good reason to do so. But I like to be in and out of these M's and W's really quickly. Just get so they don't clutter up the account. They don't sit in your account just staring at you and changing value all the time, which can be emotionally draining. I can be in, I can be out. The money can be banked or lost, but the money can be banked in the account. It frees up the capital back into the your margin back into your trading account that allows you to take other trades. If you're not over leveraging yourself. If so, sometimes I can sometimes have 5 trades open at a time. Now, if I've got 5 trades open, then that's going to use up most of my margin, and I won't be able to take another position until one of those trades is closed out. Well, with those 5 trades normally get closed quite quickly, and so therefore it frees up the margin again to allow me to go back into the market. When I used to have accounts that were 400 to 1 and the like, I've got one left that's a professional account that's 400 to 1, but I don't really use it very much. I don't need to do, so I like just have a 30 to 1 leverage, and that's fine for me. And timeframes, Angela, on the M's and W's, 1 hour and above, 15 minutes and below is a little bit tricky to make money at consistently. They look beautiful. The patterns work really well, but it's tricky to make money because the broker spreads that you have to take into account, obviously, when you're trading, these are the expenses effectively of your business, take up often too big a proportion of your trade. So let's say you've got a 2-pip spread, which some of you will have on an instrument. If your stop loss is only 10 pips away, which occasionally it will be, that's quite small, obviously, then the broker spreads 20% of your stop loss and you take profit. Now, that means that you've got to extend your take profit by 20% to get a 1-to-1 reward to risk. Now, that's hard to do consistently. Doesn't mean they don't work out well. It's just harder on the 15-minute. You have to work harder to make it to make it pay effectively to do that. But 1 hours get lots of opportunities in a week. If you look at this here, I mean, this one instrument itself, we're getting one forming now, potentially. It might not. It might just continue straight up. We have one. I've got a couple of arrows here pointing at one. We've got and another one here. So we've had price, a strong move down, a move back up, a push down again, break of the neckline here, and up we go to target. That's a W. And then what do we get? Get a push up, pull down, push up again, break of the neckline here, down to target. So W runs into an M that might run into another pattern, or whatever. And sometimes you can get 6 in a row like this, and the rhythm of the market presents itself beautifully to you. And lovely to see. And often the Aussie dollar pairs do that. But so there's a couple here of opportunities already this week that went to target very, very smoothly. And one might be presenting itself again soon, which will be interesting to see how that develops. We won't be here probably quite long enough to see it, but you can look later to see how that develops yourself. And Aussie dollar, Swiss franc, you see again the same situation here, a W bottom here. So when you're looking at this in real time, so this is the position you'd be looking at. You'd be thinking, okay, yeah, I've had an impulsive move down, I've had a pull back up, I've had a push down again. Do I want to take this trade? So you do your due diligence. And one thing that shouts out at me straight away is this area here, this level, which is where you've seen price bounce off and bounce off and bounce off again. You can ignore this candle. That's the opening candle of the week. So you've seen this level, and we've seen price bang its head against it here on the way up. So it's acted as resistance and it's acted as support here, that level. So I'd want to be interested in that area. Would I take the trade? Maybe not. It might be too close to entry. It is tight on that one to whether I'd take that trade or not. Because of that area, I'd have to do more of an assessment on that area to see how strong it was. But it looks fairly strong just on initial look. And I'd go up a time frame onto the 4 hour and go back in time a little bit further to see how price reacts at that level. just to see if it's going to cause any problem. And if I did think it was going to cause a problem, I'd manage the trade at that level if I wanted to take it. And so we'll see how price plays out. And it doesn't worry about it. So no harm done. I was prepared to manage it at that level, but it went through it beautifully and now protects the trade and then goes to profit target there. Very important, this price action here leading into the pattern. This is really, really key. That is really tough. This was the best future indicator for you. You don't need fancy indicators that are up here, whatever. As such, price action will tell you so much about what's likely to happen in the future. When you get good at reading it, it's like being able to see the probabilities that can expand in front of you. Takes a little bit of time, but it's okay. It's good, worth investing in. And then whatever strategy you're looking at, you can do that. You can benefit from it. So let's get rid of that. So there's that one there, and then this one here as well, a W bottom that went to target. Okay. There's Aussie dollar, Japanese yen, which we've just seen. Aussie dollar, United States dollar. One here off a zone. These grey areas here are institutional value zones that I love to use in my charts. That on the daily time frame here, they are areas that the institutions like to use to buy or sell from and have done for many years. And so having price now broken through that area, now sat on top of that value zone, it's acting as very strong support to any trade that's likely, or any pattern that's likely to form. And you can see here, bounced off it quite well. It's back here. There's no pattern here, but we can see how it plays out, and it's doing it again now, bouncing off. Okay. And it's not just Forex, not just currency pairs that this works on. It works on all. It works on stocks, it works on indexes, and it works on commodities as well. Very consistent around here. Now this is the DAX. This is a little just a quick pattern, just a quick one here where price ran up quite strongly, pulled back, pushed up again, broke the neckline here, and went down to target. This run up in price is important. Now, there's a red candle there that could cause issue. So again, I'll be aware of that red candle. It didn't stop price going through to target, but you need to make an assessment of that area. Why is that red candle there in an all green run up in price? Why is it? You look back and look to see if it tells you a story in the past. And the chances are that would be a fairly weak support and resistance level because price went through it pretty cleanly. But if we look at profit targets on this, reason why, well, let's say, so the neckline's here. So looking to enter the trade on this candle when it breaks the neckline, your stop loss would be 85. You can ignore that long wick there. So 85-ish. So we come down 85 on this. You need to extend it a little bit depending on what your broker spread is. So it might be down here for a take profit level here to ensure that you're taking account of your broker spread. Is that a valid setup? Well, yes, it is, because this take profit, this pattern completion level here is within the last run up in price. That's here. The bodies of this run up in price encompass where our expected price is likely to go to. And that's very important because you can see here when price came down to the bottom of this level here, this last run up in price, then it didn't like it. If you've got your profit target down here somewhere, then you've got to break through this area, this low. You might have to have a break of structure, a change of direction of the market to get there. That's unlikely to happen, or less likely to happen than just having your profit target within the last run up in price. Absolutely. Just make it easy for yourself. Don't overstretch things. You don't need to do that. It just emotionally drains you as much as anything. Just do the quick wins, in and out. Just a couple more quickly. Again, you can see if we look at that, I've got an arrow pointing at it again, just to see we've got a run up in price, pull back, push up again, and down we go. If you have to check to see whether this is what we call a wonky pattern, so invalid pattern, there is a tool to use. We look for a 1.3 extension. For the Fibonacci extension, you go to the highest point of the lowest side, which is that wick there, pull down to the neckline, which is here, go across, and if the green line is above the bodies of the candles on the left side, which is the higher side of in this case, the higher side is the left side. If the bodies are below the green line, then all is good, and they are just below. So that has validated that pattern there. You do it, that wasn't possibly 100% accurate, but that's the process for doing it. And so we validate the pattern, so we know that it's on the fringe of being invalid, but it's just about valid as a setup, which then allows you to take the trade. It's just making sure that you're doing the same thing time and time again. It allows you to backtest it then accurately as well, because there's no point in me telling you that this works. You need to understand how the methodology and the full details of the strategy, then go and backtest it accurately, and then you see it for yourself working, or you don't, but you'll see it working for yourself, and you'll do 300 of those trades as a minimum, and suddenly you'll have a massive understanding about the process, and it will be cemented in there. Heck, this does work. It won't be just me or some other person telling you a strategy works. It's you seeing it properly yourself, and that's the only way you can trust it when you're live trading. Never ever, don't just trust what I say or anybody else says. Have a look at it in detail, really then backtest the heck out of it, and make it show for yourself that it does work. Otherwise, you'll end up giving up really quickly and doing this cycle of doom, as I call it, where you're moving from one strategy to the next. Mark, how's the fib work again? Yep. So we're looking for, so we assess which side is the lower side on an M, and the higher side on a W, but we're looking at an M here. So we assess which side. It could be either side. In this case, it's the right side, and we look for the highest point on the right side. And then we apply this fib retracement tool to it. We are looking for an extension, actually. And it's a 1.3 extension that we're looking for. So click on the top of that candle, which is the wick, pull it down to the neckline, which is here. And then the 1.3 extension is the green line that's here, that the bodies have to be below. And if you want to, sorry. In the settings, you can change anything you like in this. So I know it's a bit complicated at the minute, and I don't really need these in here. But I've just changed this one here. So that extension, you can put that at 1.5 if you want, and it makes it a little bit, jumps up a bit higher. Not that you will do, because 1.3 is the right setting, but this is how you change it. So 1.3, click OK, and then you've got the green line is the one that you need to be using. The other ones are for testing the validity of entry setup candles and inefficient candles, the yellow line, 50% line. It's a good tool, that. Use it a lot. Yeah. Ruth says, how does an engulfing candle impact the M and W strategy, if any? It's only if you have to manage the trade manually. So let's just remove this. If we're going to manage a trade, so we've identified an area of support and resistance that's in between our entry and our take profit, and we decide before we take the trade that is an area that if we get a price reversal off, I'm going to manually close the trade, then the price reversals that I want to see are in the event of let's say it's a W bottom, we run into a resistance level halfway up on the way to target. If I then see a pin bar, a bearish pin bar reversal, or an engulfing candle, a bearish engulfing candle reversal off that, and the low of those candles are then subsequently taken out by the next candle or the next one after that, then I would close the trade manually. And so an engulfer doesn't affect it in taking the trade in the first place, but it can do for closing the trade out manually. So if I was assessing this is not a good setup, and it's not one that I would take, but it's an example that's just happening just recently. So it's this week. In fact, it's only just a little while ago. Actually, this morning, this was all playing out. So I'll talk about this one here, because we've got this run down in price from here, run down. We've got to move back up and a push down again. Only a very shallow one, but it's still valid. It's still a W bottom. And then on the break of the neckline here, we could be in the trade. But those of you that know this strategy at all and have had a look at it will be shouting at the screen saying, what about this area here? Yeah, absolutely. The break in the way down, so this is an impulsive move on the way down with several nice big juicy candles, but in the way of it is this consolidation area here. And it only takes one candle, but this has got three candles there that are consolidating. And so that is a blockage on the way to target. So I wouldn't take the trade because that's too close to entry really to do so. But assuming it's a little bit further away, then I might decide still to take the trade, but manage the trade around that level when price gets up to that level. And if we see what happens with it. So this is the point where you're thinking, am I going to take the trade or not? And you say, yes, I am, but I'm going to manage the trade when it reaches this level here. Let's say, for instance. And so as it moves forward, it immediately runs into that level, has a little think about it, comes off it a little bit. And I'm looking to manage the trade at this time. So I'm looking for a pin candle or an engulfing candle that then has the low of that candle exceeded thereafter, which we don't get at this stage. I mean, there's nothing there. And actually that candle there would have allowed us to go to take profit because it's only a shallow pattern. And if we're looking at, that would be around about that point would be a take profit area. So it actually would have made it to target, but we were prepared to manage the trade at that level. So it's only a quick move in and out, done. If this had been an inefficiency in the market, an inefficient candle, which I won't go into details about what one of those is at the minute, but if that had been an inefficient candle up here, then I would expect the market to come back to square that candle up because the market doesn't like inefficiencies, but that isn't an inefficient candle because of the candle that's behind it. But anyway, I'm not going to go into detail about that, but that would allow me to extend the target and I would have expected price to reach that area. But it didn't, but it wasn't. And they don't work every single time. This one here was one this week. Most of them have done this week beautifully, not a problem. But again, run up in price, pull back, push back up, break of the neckline here in the trade, and it went, didn't like it. I could see why, because, it's running into all of this area here, but, price action wasn't bad leading into it at all. Just that one candle that needed to be checked out, which is backed up by all of this behind. But anyway. Yeah, and we need to, one that just shows you why I don't take it on what platform are you using? Godwin says that's a trading view platform, that is. And I use this to do all my analysis, and then I use an MT4 platform on 2 or 3 different brokers for different things that I do, time frames and the like. I use an MT4 platform with brokers there to purely execute the trade. I don't do the analysis on the MT4. I do it all on TradingView. Yep, Kevin, you say notice that when setting up the M&W trade, you don't seem to talk about waiting for a retest of the neckline. Nope, don't look for a retest of the neckline on M's and W's. Straight in the trade. As soon as we break the neckline, you're in. That's it. Don't need a retest. Head and shoulders, which is my other method of trading, reversals, absolutely need to wait for a retest of the neckline, unless you trade in stocks where you don't necessarily need to wait for a retest. But here, this one is a move down in price, a move back up, push down again, and obviously in. Is the room is this a valid setup? Well, we measure it. Where measuring would be, entry would be here. Stop loss would be below the pattern, which is there. And then take profit or pattern completion levels up here, plus a little bit for the broker spread. Depending on what your broker spread. Is that within the bodies? Is pattern completion level, which is up here, within the bodies of this last run down in price? No, it's not. So therefore, this is an invalid setup, not taking the trade, and it will save you so many times. Just expecting too much. And as soon as price ran into this congestion here, we saw it reverse and it didn't come back. Sometimes it will just have a little pullback and then push higher. Of course it will, but it's so lower probability on that than what we know. So, and UK, so UK 100, there's one here. This has happened today. So lovely run up in price again, pull back, push back up, break of the neckline, straight down to target in one candle. One candle. And that wasn't on news. That was just the open of the market of the London session. It was, yep, straight down. Lovely. Love that. Recharge, you have to bank the money, recharge, done. The other one I use is Head and Shoulders, but I won't go into detail on that today particularly, but there's been a lot of those today. I did show one, I will show this. I did show an example. If you saw my post that I put in this week, then if we look at this on the 15-minute time frame, I talked about, well, in fact, I'll do it on here. Oh no, US dollar, Singapore dollar. This is it here. So this is very similar to what, sorry, it's all in the institutional value zone. So it's all a bit gray. But this here is a Head and Shoulders, very similar to the ones that I showed you in those posts that I did, and saying where we can get an early entry on them. And so we get, there's the head, there's the left shoulder, and there's the right shoulder. Steeply sloping neckline in between. So normally with a Head and Shoulders setup, I'll be looking to get a break, close, and retest on this, but it is, so I'd need price to break through the neckline, to close below it, retest the neckline, then go lower. But when you've got a neckline that slopes like this and it's broken structure, which is it has done, price here is broken structure over here, then it's likely that price is going to reverse and go down. So it allows us to get an early entry, which is what I talked you through on that post. And so this here, when price comes up to a similar level to the left shoulder, which is here, and we can wait for an entry setup candle, which is quite a big one, this, but it's an engulfing candle, which is great. Engulfs all of the previous candle. And as soon as we get a break below the low of that engulfing candle, we can enter the trade, which is at this level here. And then it just it played out nicely thereafter and went down lower and lower, and a little bit sideways movement, but hit the pattern completion level, which is down here. So entering up here, closing out down here. Very nice. Lovely little setup on Monday, which played out really well. Had quite a lot of, on Monday was a really good day for M's and W's. Had 8 in total, not M's and W's, Head and Shoulders. Had 8 in total on the 15-minute, and 7 of them 6 of them went to target. Really good returns on them as well. This is 2.5. There were, most of them were over 2. And occasionally with these entries like this, if you can imagine, if this is a pin candle reversal up here, you might be able to get something, like this. So you get a pin candle reversal up the top, quite a relatively small one. You can get 7s and 8s to 1s on these sort of patterns. Fantastic. You don't need many of those. Yeah, if price doesn't trigger after the engulfing candle, this is Gary. And would the order need to be cancelled? How long can you wait to let? Can it be left on the head and shoulders? Yeah. So if it doesn't trigger after this and price just goes sideways for a while, then you'll cancel this order here. So it's a sell stop order. It would be in this case. You cancel that order off and wait for another signal to give it to you to say that it's likely to go south. So a pin candle or a tweezer top or an engulfing candle. That happens. And if we don't get one, then you miss the pattern. You don't try and force your way into it. You wait for all of the conditions to be aligned, and then you can consistently get results. But really good. I really, really like that. And then now we've got loads of happening. I mean, that Aussie dollar, Japanese yen one that I pointed out to you on the 1 hour. Let's see how that's now doing. Pushing into the value zone, fair enough, okay. But this candle isn't closed yet. If this price comes down again here and closes down here, we can ignore this roguish wick, and it's still got a valid chance of being, an M top. Pound Aussie dollar was shaping up as well. Yep, here, not quite. Probably didn't quite make it. Again, we can test that. So I've had this run up in price, pull back and push back up. It's not the best right side. I wouldn't expect you necessarily to see that and test it. So it is valid, just valid. And it would be in the trade and be halfway to profit target now on that trade. You've made me miss that one. It's your fault. Yeah, I mean, well, anyway, that's it. There are quite a few lots on the Japanese yen because we had a big push, big weakening of the Japanese yen overnight because of the interest rate decisions and what have you. A spread hour UK shifted with the change to British summertime. Yes, it does, Gary. There's just a period of time that I mean, the US market shifts as well, but there's an overlap time between when the US change their clocks 2 weeks before we do. So there's an awkward time where spread hour happens an hour earlier, and it's actually extended out to be a 2 hour period of time. So from 9 o'clock UK time till 11, whereas now it's back to being 10 o'clock in the evening till 11 o'clock in the evening. You've got to avoid that, or have a plan to navigate your way around spread hour, because that's where the brokers really extend their spreads out very wide. They can move from being a 2 pip spread to a 30 pip spread, and you can think, oh, I'm in a profit here. Great, I'm in a good profit on this trade. Let's watch it, and then stopped out. Hey, how did that happen? Spread hour, just very irritating. So you have to have a plan for that, and there are 3 different ways of navigating your way around spread hour, which obviously I can't go into detail now, but really, really key to make sure you don't get caught out there. Which stocks do you suggest for the strategy, float price wise? I use NASDAQ stocks pretty much by and large on there. Most of them are NASDAQ stocks, so I'm using these here down the side. Some of them better than others. Ones that gap a lot are quite tricky to see. Overnight prices. When the market's closed, not closed, but after market. Then If they gap a lot, then they're harder to see. They're quite tricky to see at times. So see these big gaps that happen. But if you are having difficulty seeing the things happen, I mean, there's a W bottom here, quite a big one. But if you are having difficulty seeing that, then you can join up, draw in, just close up the gaps, and suddenly it looks a little. I know I'm only rushing that, but you can just do this, and it makes it look a little bit more joined together, so you can see what's happening. Yeah, Nathan. Yeah, the stocks will gap because whilst the market isn't open to us to trade, it will close. There is still activity after in the aftermarket market, basically, and so I mean that's this period here. What's that? That's 8:30 on Wednesday, and we open at 2:30 the next day. That's a hell of a lot of time, isn't it? There in between that there will be activity going on behind the scenes, and it will reflect with what happens on the opening price. And so you get this pre-market. If you've got a decent broker, you can see where the pre-market is. You can actually see it on TradingView as well. Actually see where the pre-market is all the time. You can't do anything about it because you can't trade the stocks at that time. But that's why. Just the close period. It's like a weekend gap in currencies. But even more so because there is actually activity being done. Mike says, Mike Parsons, experienced trader, saying that we've got Chef Japanese Yen, which I've got on my watch list. Yep, absolutely. It is setting up for a nice M top. Beautiful run up in price here. Pull back, push back up again. Break for the neckline. Could be in the trade. It looks okay. I mean, obviously, I've not done a due diligence check on that. No idea if it's any good or not. So, but it looks good. The initial look is good. There might be a weekly trend line in the way. There might be support and resistance. There might be news coming up that might affect it. There could be, all manner of things. Just need to just do a checklist and go through them. And then if you're okay, you get involved with it. Yeah. And then this one, there's a question that you've submitted that about about tweezers, what a tweezer looks like. And this is a US dollar CAD chart here, which gives a pretty good example. I mean, there's a rundown in price here, pull back up and push down again, which is played out now, gone to target. But tweezers, which are a part, I use pin bars, engulfing candles, and tweezers as entry setup candles on my Head and Shoulders. So I know we're talking about mainly about M's and W's, but there is a question you've submitted on this. And that is a tweezer bottom where you've got two long-wicked candles next to each other like that. They don't have to be the same size. They don't have to be the same length, but they're two long-wick candles there that are next to each other. And that's a very strong reversal signal. One of my favorites. In fact, it is my favorite. You've got a similar one-ish here. It's not ideal because this candle's got the same size wick at either end, which isn't ideal. Normally, you like to see the longer wick on the top side of this compared to the bottom, but a little bit. That's there. You've got tweezers there, tweezer top there, two long wick candles next to each other, break of the low of that, and away it goes. You can't use them and trade them on their own, but if they're part of a pattern like a Head and Shoulders pattern, they're brilliant. Love to see them. Love to trade them. Look, see if there's any more. Just quickly. Yeah, there's a couple there. There's three really there. That's not a long wick candle. That one isn't there, but these two are. So that's tweezers. Inside candle, break above it there. Yep. That isn't enough. They're not long wicked. That isn't long enough wick. That is. Those are okay. That's a tweezer top there. Didn't have a lot of follow through, but that's what I'm saying. They don't always have follow through, but they do if they're in the right place, if you know what I mean. They're a great thing to see. Um, what does it mean when a candle has no body and just a wick, by the way? Well, you tend to get you'll always have a body, but it'll just be a flat line, sort of like this one here, won't it? Can be a doji if it's right in the middle of the candle. But that actually classes as a pin candle. Big, big wick above, small wick below, bodies in the bottom 25% of the candle. Fine. That is perfectly same as that one would be the other way around. It's a bullish pin candle. Even though it's red. How can you have a red candle that's bullish? Yeah. Cool. Thanks for that, Majid. Right, let's have a look at some questions that you've submitted, and we'll whip through these and see if I can add some help to them. So let me see. Here we go. Claudio, yep, CFD. I mostly trade CFD, so yep, and everything I've talked about today mostly is about CFD trading. So yep, so hopefully that made sense today. Dean Maskell, good to see you, mate. A couple of questions. Do the images I have added about tweezers? Well, I've just answered that question there about tweezers. Hopefully that made sense on that. On there. So one or two of yours there weren't really tweezers. They're not ideal, but you need to have nice long wicks on both candles. Well, yeah, as I described. And then Gary Day, you say a question of divergence. Where is it best to gauge divergence from and to on head and shoulders patterns? Should divergence across the pattern itself be discounted like in M's and W's? Is there a cut-off number of candles or gauging purely on? Yeah, no, it's a good question. So divergence, I love divergence. I use RSI. I don't use it for overbought, oversold or anything like that. So relative strength index, very common with normal parameters on it, and I just check that to see whether there's divergence in play or not on a pattern. Between the left shoulder and the head or whatever, and the head and the right shoulder, it's irrelevant. It's no interest whatsoever for divergence. So like in M's and W's, no interest. The only divergence I'm interested in is if you go up a time frame. So let's assume you trade in the 1 hour and you've got an inverted head and shoulders pattern. So I'm looking to go long. If I have bullish divergence on a higher time frame, so that'll be on the 4 hour time frame from a reasonable distance back, and it will almost certainly be from a reasonable distance back on the highest time frame, then that is significant. I need divergence to be in play that will be significant enough for it then to have a decent push to give it a chance of going all the way to pattern completion level, to target. So little bits of divergence on the same time frame as you're trading aren't enough. Need to go up a time frame, need to see a big, definite, significant bit of divergence in play, and then it gives you that added confidence and confluence that you are that it's going to go north in that case. So yeah, up a time frame. Yepe. A pleasure. Thank you for your kind words. Entered on this W 1 hour and closed the trade after what I assume is a engulfing candle. Yeah, engulfer, absolutely. And second, would you say that the previous candle is a bullish pin bar? I think this is it here. Yeah, so this one. So this is a W bottom. You've got a beautiful rundown in price, a move back up, and a push down again. Valid W bottom, beautifully drawn. Neckline is here, so that's fine. So you're in the trade on this candle here. We've pushed up. You've identified a support and resistance level here, which is great. You've done it beautifully. I assume that, it would be backed up from the past. And another one here. So both of those are affecting the trade, potentially. And so when price comes up to that level, you're looking to manage the trade, which is great. Bangs itself against there a couple of times and then get this engulfing candle here, which on the break below the bottom of that, you'll close the trade out for a very small loss. Absolutely spot on. Yes. And is that a pin bar? Looks like it. I'd have to check to make sure that that is greater than 50% of the range of the candle, which I think it is. So the wick needs to be greater than 50%, and the body, part of the body, needs to be in the top 25%, so the top quarter of the range of the candle. And it looks like it is. Just about a pin bar. And so nice to have parameters to work to. But great, great question. And on the same pattern, would this be classed as valid divergence? So here, absolutely, yes, it is. Now this is on the 1 hour, and this is a 1 hour. So I would like to see it go up to the 4 hour to check it, to see divergence on there. But there is divergence in play, and it is quite significant divergence because this is from a long way away. And so what we mean by divergence is that the lows here, we're making higher lows and higher highs, but the significance is the higher lows all the way up here. So we're going up, higher lows. What's happening on the RSI here? Well, we're actually making from the same point here, we're making a lower low. A lower low. So that is a lower low here. That's different to this. We're diverging. And that is what we call hidden bullish divergence, which indicates that the next move is likely to be up. So good. Yeah, really good work. Well done. Neil, still back testing, but I saw this on the 4 hour for Euro SEK, a W going straight into an M. Let's have a look at it. Yeah, okay, so I'm pushed down. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Yeah, we're a bit thin on the ground for candles. That's got 6 candles in the pattern. You go left from the neckline. That's the first candle. Then 2, 3, 4, 5. We have the neckline broken on the 5th one. We had it broken again on the 6th one, which is okay. You could argue we've had a retest of it in the 7th, so you could go on the 7th. So just about valid. And then a move up. And then we've got 1, 2, 3, 4, 5 candles here. 6th one is here. Not enough candles in the pattern. We need 7 or more. So that's invalid, the second one. This one just about valid. This one invalid. But yes, good spot. Just the number of candles that are wrong. Everything else was good. Okay, Carol, good to see you. Trust you're doing well. Yeah, absolutely. Trouble fully understanding pivot points. Yeah, and I know you've got a tool there for it, and now you found it. I don't use anything like that, but I suppose I've looked at the markets for years, and so I'm quite happy to assess them myself. And I think these miss too many when you've got these indicators like this. But there's a fractal indicator that gives you pretty much all the pivots that you can customize a bit. So that's all right. But I just, I look at them myself. The marker. Do you see an inefficient candle in? Okay. Do you ever see an inefficient candle in one time frame, say on the 4 hour, and then when you switch up or down one time frame, all candles appear to be squared up? Good question. This, yeah, or vice versa, where there isn't an inefficient candle in the time frame you're trading, but there are above. Yes, you do. You do come across that. But I work on the time frame for inefficient candles. I work on the time frame that I am trading, and that's mostly the 1 hour on the M's and W's, and the 1 hours have the most significant inefficiencies in the market because a lot of institutional traders will be using the 1 hour time frame to enter their trade. So market inefficiencies are ones they're very much aware of on the 1 hour time frame. And so I tend to stick to that. So I don't worry if there's one above or there isn't one above or whatever. I will stick to whatever I've got on my time frame that I'm trading. If it's the 1 hour, I'm looking for inefficient candles on the 1 hour. If I'm on the 4 hour, then I'm looking for it on the 4 hour. So I mean trading it on the 4 hour and trading it on the 1 hour. I'm looking for inefficiencies on that. Yeah, good stuff, Peter. It doesn't come easy, but if you get good at learning how to do divergence or inefficiency in the markets or reading price action, whatever it is, if you get good at that, you're ahead of the game. You're ahead of 99% of traders straight away. Okay. Okay, Kate, just a quick question about trading plans. How many trades do you usually take per day, week on average? It does vary. I've taken less now because of my commitments in the cafe and academy than I used to do. I used to take around about 15 to 20 trades a week. I take less now, maybe half of that now. Because what I need to be really, really focused on what I'm doing. If I'm trading, then I don't want anything to be bothering me before I've done my, well, a few minutes before I start doing my analysis, then during my analysis, and then during or my assessment of the pattern, and then my actual trading of that pattern. So I need to be in a zone. I need to be in the zone to do that. And I found that if I'm not, I get sloppy and I make mistakes. So it does mean that my windows for trading are a little bit reduced now because I'm committed to do a few live sessions like this, and I do this regularly in the academy, of course, as well. And as wonderful as it is, and I love to share what I do, it does restrict the number of trades I take. Yeah, these so daily charts. Yeah, these looked all right actually. I think you'd got a decent look on these. Let's have a look. Yeah, good run up in price. Pull back. It's not an ideal pullback because that wick is just looking like chopped sideways, really. Not ideal on this one. But it is just about an M top. This one here is better. Run down in price, push back up and push down again. Clear moves up, clear move down. Definitely better. Pound New Zealand. Look at that on the daily. How's that one doing? Yeah, there we go. It's taken off quite well. Sorry, it's all messy, isn't it, on this? Let me get you on a better chart. That's my demonstration chart. Yeah, so we have this rundown in price here, move back up, push down to this level here. At that point, breaking the neckline, off it goes. Virtually hit profit target, I would have thought. No inefficiencies up here, so that would do it, just a one-to-one. As a market inefficiency, there we go. These are inefficient candles here. That one might be actually, that one's just about an inefficient candle because we haven't had anything in the future square it up, which means that it hasn't come back to the middle of this candle. Price hasn't come back to the middle of that candle. It doesn't come back to the middle of that candle, and it hasn't come back to the middle of that one. It did to this one with this candle here, came back and tagged it before going off. This one here has been squared up now, so the middle of that candle, go right, that's been squared up. Market came down, squared it up, went off. But this is still, in theory, outstanding, been squared up by this one. So this one came down, tagged that square up at that one, market went off. This is what happens more often than not. It tags them in order. Tagged that one, went off, came down, tagged this one, and gone off again. So that helps again. And then this one here is just about an inefficient candle. It's the yellow line I'm interested in. Yeah, small inefficiency there, not as big as the other ones. And we've got head and shoulders forming here. Hopefully you can see that. So you got left shoulder, right shoulder, and left one forming. So we could easily be seeing this rolling over and coming down soon, but we might still finish this push up and then it will come down. It's all good. Okie dokie. So where were we? Let me get. There we go. Back to questions. So good work, Neil. Like that. Well done, mate. Yvonne, can you share how my daily routine is? Yeah, I mean, I touched on it earlier. 6:30, sorry, 5:45 in the morning, I analyze the 1 hour charts for M's and W's and head and shoulders. Then I move to the 15-minute for the head and shoulders only. And then I move up to the 4 hours to go through all my watch list to look for opportunities on those. And then I flag up my down the side here with different flags, different colored flags to signify different things that I'm keeping my eye on. And so my analysis is then done for that period, and then just keep coming back to it from time to time. You have to take breaks. You're absolutely right. And I do take breaks, do a bit of exercise, just go and relax. Maybe, even watch the television shortly for a short period of time or whatever, just to relax. And then come back to it. I might put alerts on the screen so they'll ding out and let me know when price reaches certain levels, so I don't have to be watching them all the time. And so, yeah. And then I close things down. It doesn't feel like working though when you're doing it like this, because I can take breaks whenever I like, pretty much. Some days are really busy because there's loads and loads of trades on, but other days are very quiet, very quiet. And that's something people that have daily targets can struggle with this, because if the markets are quiet and aren't presenting what you want to see, then you can be tempted to try and force a trade out there because you've got a daily target to meet. I don't have those, and don't have any targets, to be fair. I just trade the patterns as they present themselves. Some months will be blinding months and some months will be quiet months. Don't worry about it. There's no monthly target, weekly target, or daily target. It's just trading the patterns as they are when they present themselves to me. And I'm not in control of that. So how can I have a target? There we go. Dan's saying, what's your monthly target, or what do you expect to get gain on M's and W's? M's and W's 8%, something like that. But it's not, as I say, a target. Raphael, hope you're well. Traded mainly support and supply and demand. But I've just started to have a look at mine. Yep. I mean, hopefully you've picked up a bit of what I do with M's and W's here from what we've talked about today. And the book, of course, gives you a lot more information if you want to get that. And if you ever do fancy having a little taste of the quick win in the academy, then have a go at that. You can have a week for virtually nothing. Thanks, Yashir. Francois. Yeah, good question. Is the W&M strategy tradable on any time frame? Anything above 15 minutes? Yes. Also, how do you deal with the correlation between pairs? Thanks. Absolutely key. Risk management in trading is so important. You don't want to be over leveraging your account. So if you're trading the same type of pairs that are correlated to each other, or inversely correlated to each other, which you've got to be aware of, then you can be exposed to big on your account. Let's say I had 5 positions open, all at 1% risk, and they all at 1% risk, and they all correlated in some way to each other. Then if that particular if news came out or whatever that pushed price in the wrong direction for me, for my trades, then all 5 of those could be stopped out. Now that's a 5% loss on your account. Don't want that to happen. My maximum I will allow is 2% as a loss on the account. So I will limit what I take. I will not take certain trades if I'm over exposing my account. Really good, but getting to know which ones are correlated and inversely correlated, and again, work you need to do, which is not, it isn't just quick look at the charts and away you go. If you turn this into a business, you've got to treat it as a business, and you have to know all the ins and outs of that, which is not, it's not a quick, here's a strategy, off you go, make a million. Claudia says, how much would you put into a trading pot if you're starting out live trading? Well, assume you've done all the back testing, you know the strategy inside and out, do all the back testing, then you've done a demo trade and proved yourself profitable for 3 months in a row as a minimum, and then you go into live trading, you put in a gentle amount for a start, that you do not worry that at 1% or 0.5% risk that you're taking on the trade that you lose that money. the money that you're on each trade. It's not going to cause you stress. And then you only build that up gradually as you can cope with the amount of money that you're risking on each trade. And so whatever that, and that will be different to everybody else. So do I use, so Stephen said, do I use indicators with alerts to scan? No, just the RSI to look for divergence. I do look at EMAs to see if, so I've got a 50 EMA, a 100 EMA, so exponential moving average, and a 200 exponential moving average that I have on the charts occasionally, just to look to see if price is overextended. And if it's extended a long way away from the EMAs, that's where price is happiest being. So it often comes back to the EMAs. And if there's a pattern that happens at this extension, when price is extended above or below, then it's likely that they will come back. And so a pattern happens at those extension points. It's good. Adds to the probability of the trade. But that's all. We're nearly there. John Robles, when you're in a trade and it's not gone to pattern completion level, but has gone 70% of the way to pattern completion and a news event will soon come, will you exit the trade before the news or let the trade open over the news? Close it. If it's a news event, a big data release that's likely to affect your open trade, then close it, because you're just gambling else, just on whatever the result of that news is. And spreads will widen as well at that time. Brokers will use that as an excuse to widen the spread. Yeah, and the 3-star USD news events can affect lots of currency pairs. Absolutely, they do. It's not just US dollar. So economic news coming out of the United States will affect Aussie dollar, Swiss franc. Sometimes as much, if not even more, than the US dollar itself. So you have to be aware, and we've got projects to do within the courses that we're running in the academy, actually, that go through this to show how, and it's really important, how the currencies are affected, even if they're not related. You don't think they're related to the news that's coming out, and we do a look to see which ones are and which ones aren't. News events, yeah, you just need to plan your way around the news events, know when you can trade, make sure you don't take a trade right in front of news, so you're giving your trade enough time to better play out, at least to get into a really good profit before news comes along, and then close out the trade. If it's a smallish time frame, so 15-minute and 1 hour, close out the trade. I will keep 4 hours and daily trades open through most news events. Not something like the non-farm payroll. That's too big a move, even for a 4 hour and daily. Well, daily's all right, but 4 hour definitely not good. But no, I'll close out before any 3-star event that could be related to my trade. In what order do you prioritize checking extra information? So I do it in institutional value zones first, because they're obvious, they're on my chart, then news, then support and resistance, then weekly trend lines, and then divergence afterwards. Okay, last question. Question on head and shoulders. In the example screenshot, I've placed an order off the back of what I think is an engulfing candle, but the trade didn't trigger on the next candle. So yeah, let's have a look here. So yeah, you've got an engulfing candle here. So this is an inverted head and shoulders, had a break, close, and retest the neckline. So all good. We can look for an entry. You've got an entry on that candle, perfectly identified. And then on the one after it, you said it didn't trigger, but it would have done, because the price went above the engulfing candle here. It doesn't have to close above it, just went above it. So it would have, you've been in the trade at that level. But if it hadn't have triggered, then you can wait another candle to see if it would trigger above. If it's an inside candle, you can wait another candle to trigger above this trade. There. If not, then you wait for another setup candle, like an engulfer or a pin bar or tweezers, pair of tweezers. So thank you for submitting those, and hopefully you found that of value. So I know we've rushed through quite a lot of things there, but I will pass you back to Jonathan, and I hope you've had an interesting time anyway.
absolutely wonderful. I saw some people asking if there's a recording. There certainly will be. It'll be up as soon as it's rendered. Simon, thank you so much. Wasn't that good, guys? Now we all know about M's and W's. And if you are so inclined, tomorrow on the cafe, I'm going to be putting this into practice. We're going to be doing some back testing, putting into practice what Simon taught us about M's and W's. So you're more than welcome to join me, and we shall bash through and try and apply the rules as best we can. Now, folks, before you go anyway, those of you who are still here, hold your horses for 2 secs. I'm going to stop recording. So let me just stop recording. And stop recording here as well. There we go. There, that's all stopped. So, students who actually stay to the end, these live events, usually get